All right, let's get started. It's already 2:05, and thank you everybody for taking time out on a Sunday afternoon. The idea is to do this over the next couple of hours. Yeah, I'm audible, right? So just say yes or no in the chat, a couple of you. Yeah, thanks. All right. Yeah, good enough. So let's get started. So idea is to do this over the next couple of hours. And I'm not sure, it's not something that I have rehearsed or anything like that. So I don't know how long it will take. I'll try to do this over the next couple of hours, and maybe leave some time for Q&A also. And again, the Q&A also, I'll prefer if we do it over chat, because typically on the video it gets kind of longer. So put out your questions in the chat when I indicate you post the presentation, and I'll take up a few questions which I feel will benefit most people here. So let's get started. I'll just share my screen again. Yeah, so let me put this chart here. Yeah. So I hope you can see my screen. All right, let's get started. So yeah, as usual, before we start, a quick disclaimer. A lot of you are worried about whether the recording will be there or not. So please focus on what we are doing now. Let's worry about the recording bit and all, later on. Focus on what we are going to talk about now. And recording, I will try my best to do it. Like I said, this is the first time I'm doing it. I'll figure it out. Okay. So yeah, so let's get started. And yeah, there we go. So a quick disclaimer. Since I manage multiple SEBI products, right? So this is important, and I want to ensure that whatever we discuss here, you take it in the right spirit. So the idea is to just share a few concepts, and okay, somebody says it's not audible. So am I audible to the rest of you? Okay. So I'll just go ahead, and I'll not worry about one or two people in the chat. They might be having some of their own issues. It's fine. Okay, so I mean, all of you know this, so I don't, do your own work, and, don't take any stock sectors, anything we discuss, even concepts, right? Don't just blindly try to do a copy paste. This is the idea is to introduce you to some foundational concepts, and which I hope will be useful for you in your own trading and investing, right? So let's get started. So see, what we want to discuss over the next, hour and a half is basically big and deep concepts, right? These are foundational concepts which have been around for a long time. And the reason why I am talking about these concepts is because when I started out, right, in the jungle of investing, right, it's very easy to get an entry, right? Anybody with a few thousands can get into the market. More so nowadays, with quickly you can open a broking account and get going. But most of us are lost when it comes to really understanding what the foundational principles of the markets are. And I took a lot of pains to learn this, and I hope that with this session I can reduce if not a lot, if a few years from your learning, then my job will be done, right? So again, these are not original concepts, so I want to make it very clear. It's not something I have invented. I have learned from many people in the markets. I've been very curious about the only quality that I had, whatever little success I've had in the markets, it's because I've been curious and I love markets. I'm very passionate about the subject, and I spend hours and hours trying to learn from multiple people. So I have not limited myself to learning from a set of styles or a set of strategies. I have learned from many people. So it's not original, it's just aggregated. And I have also understood these concepts, very deeply, and a lot of nuances around these concepts very deeply, some of which I'll try to share, some of which you will have to learn yourselves by, putting in the work. So all of these concepts are used by professional investors and traders. Any professional investor and trader you talk to, they cannot deny that they use these foundational concepts, in their trading. So it's much like when you learn to swim, right? So you have to first learn how to float. Only then can you learn the strokes and the butterfly stroke and the complicated strokes. So what happens to us as investors and traders is we are just thrown into the pool, and we are immediately start talking about Warren Buffett and George Soros. Those guys are at a completely different level, right? So if you understand these concepts, foundational concepts, you'll be in a much better position to understand how these professional guys operate. Okay. Acknowledgements, a lot of people I've learned from. I don't want to take any specific names, but both the Indian markets and the global markets, that much I will say. There are a lot of very good investors and traders who are who keep sharing their knowledge in the Indian markets. And do not limit yourself only to the Indian markets. With Twitter and YouTube, you can learn from so many stalwart international investors, and these investors also share very freely, and all of the knowledge is available out there. Go out and explore, and maybe we'll talk a little bit about that later, how you can go about it. But a lot of acknowledgements, again, nothing original, just aggregated and understood. So let's start. So structural principles, right? So this is what I said. The first topic, right, is structural principles. So what are structural principles? Why are they called structural principles, right? So the principles that we're going to talk about, some of them, they are called structural principles because they work across markets. So these are not principles that will work only in the Indian market. They will work in the Indian market. They will work in the US markets. They will work in the Korean market. They will work in the Pakistani market. So any market that you go to, these principles will work. Not only that, these principles will also work across time frames. So what I mean by that is, an intraday trader can also put these principles to use, and an investor who invests, across decades also can, put these principles to use. And these principles have been around from the 1800s to now. So it is nothing new. It is the same things. That is why they are foundational in nature, right? So the factors that impact gravity in nature, right, they have been there, since the beginning of the earth, right? So it's similar. So these are factors which have been around from a very, very long time, and they'll continue to be around for the next several years and several decades. That is what makes them structural. So why do these structural principles exist, right? So the structural principles exist because they are inherent to how price action works, right? They are inherent to how humans interact with each other when it comes to demand and supply. So these are structural in nature because that is essentially how a group of humans, a collections of humans come together and operate, in any market environment. It need not be a stock market only. Any such market where there's a transaction going on, you will be able to see these kind of structural principles. Again, I want to clarify that, see, these are principles, or these are just tendencies. These are not exact formulas, right? So they just, everything in market is a probability. So these are just tendencies or principles that guide you in trying to improve your probability of winning in the market. They are not exact formulas, and how to derive principles from the principles, exact formulas, is something we will also discuss in this presentation. So let's get started with the structural principles. The first structural principle that I want to talk about is the principle of catalysts, right? I've spoken a lot about this on Twitter also, and I want to start with this principle because any big move in the market, right? Go back and study any move in the market. Any big move in the market, and there will always be a catalyst that started that move. Right? There'll always be a catalyst that started that move. See, some of you are requesting to be recorded locally. Please don't do that. I want to avoid all this here. So if and when the recording is available to me, I'll make it available to you. So please don't do all of that. So this will disturb the flow. So please avoid doing that. So it's a genuine request. Right. So the idea of catalysts, right? So this is something which is again foundational. Go back and study any big move in the market. You will see that there'll always be a catalyst. Without a catalyst, you can never have a big move in the markets, right? That is how markets operate, right? There are typically two types of catalysts which are there, which is one is an earnings catalyst and one is a news catalyst, right? I'll give you a few examples which will sort of help you understand this better. Let me just see if I can share my chart. Is this chart visible to you? Okay, so you're not able to see the chart. 1 second. Let me do a stop share and let me share it again. Is it visible now? All right. So this is the chart of a stock called Electra. Okay. So I've picked a few stocks just to show you some examples. Right. So let me just go back. Okay. And let's look at this day here. Okay. So this was a stock which was not doing anything. In fact, it was falling. Right. It was not doing anything on this particular day. Right. 24th Feb 23. At a price of around, it was trading around 450, 460. On this particular day, the news came that Electra is going to deliver so and so many buses for the first time. First time this news came, I have in fact even traded this, right? This started a big move, right? The stock went from 480 on that day to about 1,400 at the highs and maybe around somewhere that now, 1,200 now. So this is one example of a news-based catalyst, right? On a surprising news, a big move starts. A big move has started, right? Similarly, I'll show you another one which is related to earnings, right? This is Apar, another stock. I think it was this day here, okay? The stock again, just see what the stock was in an uptrend, but it underwent a correction and all of that. On this particular day, the stock released very, very good earnings numbers. And that earnings number proved to be a catalyst for the stock to start going up. And the stock went up from about 1,700 on that day, all the way to 5,400 now, almost 3 times, right? So this was the day that big catalyst happens, right? So I can give you many, many, many such examples, but like I said, I want to cover a lot of concepts today, and maybe in the future sessions I can take you deeper into each one of these concepts. But I'm sure you get the idea. But go back and do this yourself. Check any big move, go and do the research. You will find that the beginning of the move, there was always a catalyst which made that move happen. And knowing that catalyst, is very important for you to be able to trade or invest in that stock. Let's go back to our presentation again. Yeah. Presentation is visible? Yes. All right, good. So the second question, right? So every day you will get so many different types of news, so many different types of earnings during earnings season. So it is very important to understand the idea of a strength of a catalyst. Not every catalyst is a strong catalyst, right? Most of the catalysts will be weak in nature. There will be a few catalysts which are strong and genuine catalysts, which will lead to multi-month and multi-year moves. There will be catalysts which are like story catalysts, right? Because when I say genuine and when I say story, the difference typically is that genuine is typically backed by earnings, right? Genuine is typically backed by something really foundational happening in that stock or sector. It could be a management change. A management change is a genuine catalyst, and earnings surprise the genuine catalyst. Many a times there are story stocks, right, which basically are stocks where there is some news that so and so will happen, EV and all of that, right? This Electra kind of a thing are sometimes not 100% genuine catalyst. They are based on some story that so and so will happen 2 years down the line, 3 years down the line, so even they are very strong. People think that story catalysts are weak, but story catalysts also are very strong and can lead to multi-month and multi-year moves. Some of the catalysts, or at least most of the catalysts will be weak in nature, right? So they will give you a 1 or 2 day bounce and they will then fizzle off. So it is very important to understand, the nature of the catalyst, and that is what you have to develop over time to analyze the strength of the catalyst. Some of you are saying no voice. Is that so? Okay, this is very confusing. I'm sure few of you, yeah. So I think whenever somebody says that, I just request the others to just guide me that it's all clear. Okay. Apologies again. First time, so please bear with me. All right. So catalyst. So this is a very, very big thing. And every time you are talking about a stock to anybody, please ask yourself or ask that person, what is the catalyst, right? Is it an earnings-based catalyst? Is it a news-based catalyst? What is the strength of the catalyst? Figure this out, and you will see that once you understand what is driving the stock, you will be in a much better position to take decisions, right? So this is principle number one. Let's move on to principle number two, which is momentum. I don't think momentum needs a lot of introduction, right? All of you, especially over the last 2-3 years, right, from the post-COVID market, it's been all about momentum. Again, a lot of people confuse momentum to be a strategy in itself, right? So momentum in itself is not a strategy, actually. You can use momentum to build strategies, but momentum is just a tendency. So like I said, momentum is just a principle, right? So stocks, what does momentum say basically, right? What momentum, the structural principle of momentum says is stocks which show strong price movement in one direction will have a high probability of continuing in the same direction. So what this principle tells us is if a stock has done very well in the last 1 month, it is likely to do well in the next 1 month again. Or if the stock has done very well in the last 3 months, it is likely to do very well in the next 3 months, and so on, right? Momentum is called as the biggest anomaly in the markets. Why is it called the biggest anomaly in the markets? Because according to efficient market theory, or the theory, for those of you who don't know, efficient market theory is a theory which says that you can't beat the market because the market is very efficient in discounting all the information immediately. But there are hundreds of investors, traders who routinely beat the market. And one of the strongest principles on which those traders and investors work is momentum. And momentum, is something which has defied the efficient market hypothesis. Different types of momentums are there in the market. There is short-term momentum, there is long-term momentum. Essentially what that means is you can use momentum over a short time frame, like I said, 1 month or a 3-month time frame, even on an intraday time frame, right? A stock which has been strong in the first 2-3 hours in the morning is likely to be strong towards the close also, right? So these are all tendencies. Again, there is nothing short, but these are just tendencies. Similarly, long-term momentum, right? Long-term momentum can be price momentum or fundamental momentum also. So when I say momentum, please do not think that it is only about price. Momentum is a structural principle. It can be applied to price. It can be applied even to fundamentals, right? So if you see a lot of investors, the coffee can investors and all, essentially what they are doing is they are betting on long-term momentum. Why are they betting on Asian Paints and why are they betting on D-Marts of the world or Asian Paints of the world? Because these stocks have shown both price as well as fundamental momentum for a long time. And they are expecting that because they have done that for the last 10 years, they will do that again for the next 10 years, right? So again, two other major types of momentum in which market participants categorize is relative momentum and absolute momentum. A lot of strategies are actually being run today on relative momentum. And relative momentum essentially is ranking stocks on the basis of their performance. So a relative momentum person will say that I will invest in the top 30 stocks by price performance over the last 1 quarter, right? And if some stocks goes out of that list, then they will replace it with a new stock which has become in the top 30 stocks, right? So the problem with relative momentum, according to me, is that it is a late signal. Because just imagine a stock, if it has to come in the top 30 list of the entire market, it should have made a big move, right? So it is kind of a late signal, but still it is shown that relative momentum works. The other problem with relative momentum is during bear markets also relative momentum will give you an output, right? So relative momentum, even in a bear market, let's say all the stocks are down, everything is negative, but you can still get a list of top 30 stocks, which are the strongest versus the others. But the problem with that is, again, actually there is no momentum. It's so there is a lot of conceptual inclarity here, whereby when it comes to relative momentum, but it still is used in the market. What I prefer is an absolute momentum. An absolute momentum only tells you about a particular stock or a particular sector, right? Is that in momentum or not? And you can find absolute momentum much earlier. You don't have to wait for the stock to come in the top 30 rank. So you can find absolute momentum much earlier. All in all, again, a tendency that you have to know of, momentum is a very strong tendency. A lot of people have a lot of notions about momentum, that it is something bad or it is something, and I'll probably clarify all of that. Like I said, there are a lot of nuances to all this. I'll try to talk about as much of them as possible. When you combine a couple of structural principles, right, that is when you will come to know, how basically you can sort of use them. So momentum, so like I said, besides catalysts, and now we moved on to momentum. Momentum is something which both on the long side and short side is the idea that trends will persist in the direction in which they have been persisting so far. Let's move on to the next one, which is mean reversion, right? Now, mean reversion is based on the principle that trees don't grow to skies, right? Everything that goes up has to come down. Everything that goes down has to come up. Again, it is a very important principle. I call it the grandfather of all tendencies, right? Why I call it the grandfather of all tendencies is because whether you are using a catalyst, whether you are using a momentum, whether you are using any other structural principle, mean reversion can come into the picture and kill them all, right? So mean reversion is a principle that has to be at the back of your mind always whenever you are in the market. So what mean reversion means is any trend across any time frame cannot sustain forever. If the trend has gone in one direction for too long, it will come back. Or if the stock has gone up too much, it will pull back and correct. You cannot help it. It's a principle. If a stock has fallen too much, it will see a bounce, right? So this is what mean reversion means. More than stocks, it works on indices. It works beautifully on indices. It works beautifully on portfolios. It works beautifully on styles. So when I say indices, right, if you go back and study the history of, let's say, Sensex, or even if you go and study the S&P 500, which has a much longer history, and you study their charts, you will find that whenever these indices have gone up way too much, it is always followed by a period of correction. And whenever the indices have fallen way too much, it is always followed by a period of bounce back and reclaiming of the old highs, right? This is a very powerful principle, and you can integrate this into many aspects of your own strategies and setups. The simplest strategy, which I keep telling all investors, is that never let a correction go waste. Whenever you see a correction, you have to, because that mean reversion will come into picture, right? It cannot happen that something just keeps falling forever. In some cases, it will fall more. In some cases, it will fall less. But, mean reversion is something that will come into the picture. So, whether you are, investing via mutual funds or you have your own portfolio, if there is a market-wide fall, it is telling you that the fall is going to end at some point in time. Okay. Again, mean reversion on stocks, mean reversion on styles we have seen, right? So some of the strategies are very famous, which work for a particular period of time, and then they stop working, right? We have seen mean reversion in our own portfolios, right? When the stocks, a certain set of stocks do very well, and another set of stocks don't do well. Whatever is not doing well, we tend to sell them, but the moment we sell them, they go back up. So again, another principle that you have to always remember is mean reversion. What is all this? Okay. The next principle is that of volatility contraction, right? Again, I will try to show you. So what volatility contraction says is that whenever there is a contraction of volatility, it always leads to an expansion on, either the upside or the downside. So what volatility contraction means is that there is a demand and supply equilibrium. The demand and supply equilibrium uh, cannot, stay for long, because markets are a continuous source of buying and selling. People are always doing something or the other. A demand supply equilibrium cannot last long. So a mean reverse, a breakout or a breakdown out of a volatility contraction is again a structural principle that you have to remember. Let me show some of these to you on a chart. Typically, what happens is that whenever there is a demand supply, equilibrium, a small push on either sides leads to a big move. So let me show this principle to you on a chart. Let me stop the share. And yes, please, some of you are just drawing some lines on the screen. Please don't do that. Let me go back to the chart. Yeah. Let me show you this chart called RVNL. Okay. This has multiple volatility contractions. Look at this one here. Okay. So you have a period here where the volatility has almost gone to zero, right? Look at the size of these candles, right? Look at the difference between the highs and the lows. It's almost nothing, and that is what triggers a big move. Because what happened here is that demand supply came into an equilibrium, and a small push can lead to a big move, right? If you again see here, again volatility contraction was there, small push led to a move. Again here you will see volatility contracting, small push, and you got a big move, right? Again, volatility contraction is more of a pattern or a principle which traders use, not so much for the investors, but it is good to know this, this principle. And I'll show you how you can combine this with other structural principles to build strategies on your own. I think I'll have to somehow figure out a way to disable this people drawing things on the screen. Right. Let's go back to our presentation. So next is exhaustion, right? The idea of exhaustion. Now, exhaustion is another principle which basically is about very similar to mean reversion, but it is an extreme version of mean reversion, right? So it is like whenever things go into a euphoric phase, right? Whether it is fundamentals, whether it is price, whenever you see something happening at an extreme level, you have to get ready for the other side of it, right? So now so not only in terms of price, right? So whatever I'm talking about, please do not limit yourself by thinking only in terms of price. Even fundamentals, right? Even margins. When we speak of margins, apply this principle of exhaustion, right? When margins expand so much that they get super high, you have to get ready for a period of margin compression. Similarly, right, when you see margins compress, right, especially in cyclicals, you will see that there is an exhaustion on the margins. The margins compress way too much. A double-digit margin goes into low single digits. You have to get ready for a turnaround in margins. And the principle of exhaustion can give you very large number of setups and trading ideas, right? A lot of intraday traders, especially in the US, who use the principle of exhaustion for intraday shorting. This is a principle which is used, time and again by intraday traders to what they call as fade the move, right? So if there's a large move, especially in the US, not so much in Indian markets, but you will see stocks going up 1,000% in a matter of 2-3 days. And stocks like that and are then shorted by professional traders as well as hedge funds, to take advantage of the principle of exhaustion. So the principle of exhaustion works both on the long side as well as the short side. It can work, for both price, volume, which is self-explanatory. The volume part comes when you've had a large move. You will see that, when the euphoria phase is near its end, you will see the maximum volume, right? Sometimes people say that when the volume is high, it's very good. But volume is high is good only if you know the right context. A high volume is good if it's at the beginning of the move. A high volume is very bad if it's at the end of the move, because at the end of the move, it is suggesting an exhaustive phase, which is going to lead to the other side of the move starting soon. Similarly, in breadth, right? We talk about market breadth, which is how many stocks in the market are hitting 52-week highs, how many stocks hitting 52-week lows, how many stocks are above the 10 EMA, 20 EMA. And a lot of people do a lot of these things, which is again, in a normal situation, you can't make anything out. But when things get to extreme is when the breadth comes into play. So one of the very strong indicators which people use as a market timing indicator is when the breadth of the stocks, right, goes into single digits. So when the number of stocks which are above, let's say, the 50-day moving average or 200-day moving average is only, let's say, 2%, 3%, 5%, that means that the stock has extended too much to the downside. Exhaustion is likely to happen, and the stock and the market is going to reverse and start going back up. So this is the principle of exhaustion. Let me show this principle to you on a chart if I can. Go back. I think I picked this IRCTC for this. Right. So this, right. So this recent move is a good example, but also I think IRCTC made this big move sometime in the past. Yeah, look at this. This IRCTC made a huge move, right? And this is what. So when this move is already happening, you have to prepare yourself that there is going to be exhaustion here. There is going to be exhaustion. You have to be ready, and you have to wait for the day when the exhaustion take place. This is the day when the exhaustion took place. Big price move, like it moved from what, 546 to 1,200 or so, like a double in a matter of a month, I guess. Like September beginning to October, yeah, maybe a month and a half, it doubled, right? So when a move like this happens, you have to get ready for exhaustion. And exhaustion happens. See the volume also, huge volumes happening, which is also signifying exhaustion. Like I said, volume at the end of the move leads to exhaustion. And the price on that day, right, it closed at 1,087, and it just fell all the way to 50% to 568 before it started its next move. So this is how, exhaustion, works. Next, last three structural principles, and then we'll move to setups. So a quick three, right? So these are three, again, important structural principles. One is neglect, right? The idea of neglect is a very important idea. Basically what it means is that whenever there is a price neglect or a media or analyst neglect, which means that a stock that is nobody is talking about is holding a lot of potential in it. It means that it's holding a lot of potential in it. If a catalyst comes into the picture and you combine it with the idea of neglect, you can get a very good strategy. Similarly, time neglect, right? A lot of people talk about long consolidations, stock making a new high after 18 years, 13 years. What is that? It is nothing but the principle of neglect, principle of time neglect. A great example of this in the recent times is the ESG theme, right? Because of the ESG theme, so many stocks, leave the last 1 year, look at the period before that, stocks like Coal India, NTPC, ITC, these stocks were neglected and, in fact, made fun of, right? And when you see such things in the market, you have to be reminded of the structural principle that there is a lot of neglect going on. So if something positive happens here, there is money to be made, right? So neglect is very important. Keep it, in your, tool set, the next time you come across any sort of neglect, price, media, time, anything. This next one is age, right? The idea of age. like I said, a lot of people who trade momentum, they ignore the concept of age, right? Everything has an age, right? And you want young trends. You do not want old trends, right? So when you are trading momentum or anything, you have to combine that with the idea of age. If it is something which has just happened, your probability of making money is more, rather than if something has been happening for the last 3 years and now you have woken up and now you are participating, then you are probably late. So the concept of old or young is something very important and should be applied at different places. Like I said, not only about price, even earnings, right? Only the first earnings surprise or the second earnings surprise is what matters. If the company has been surprising for the last 7 quarters, it has no value, right? Similarly, if you look at like I said, the price trends. If something has been going up for the last 3 years, then you're probably late to the party. So age is another concept which you have to keep in mind. And finally, size, right? Size is also a tendency, right? Smaller size tends to make more powerful moves. It is something everybody knows, but it's important to reiterate that just to complete the discussion. Uh, Large companies, by definition, cannot move so much, right? When I say size, I mean in terms of market cap or in terms of float, both, right? If you want to consider the fact that if you are dealing in something which is small in size, you have to be prepared for a much more explosive moves. And if you're dealing with something which is large in size, then you have to be more sedate about your expectations. Now, that doesn't mean that you should only trade small stocks and not invest in large stocks. It is completely a function of your strategy. But what I'm trying to tell you is that anything that is small will be much more easily manipulated, much more easily, the moves on both sides are going to be much more extreme than anything that is large. So it is just a principle that you have to keep in mind. So we covered all the structural principles. We started from catalysts. We spoke about how any big move, you need a catalyst. We spoke about momentum, which said that something that is moving in one direction, will continue to move in that direction. We spoke about mean reversion, which is basically the idea that nothing continues forever, right? So you have to expect the other side to happen when one side has been going on for too long. Now, if you just think about it, right, these first three tendencies, catalysts, momentum, and mean reversion, they very nicely correlate to Newton's three laws of motion, right? It's that, and that is why I'm saying it's so beautiful, right? Markets are so beautiful because it's essentially, it's trying to mimic what happens in nature. Because essentially, even the acts of humans, right? It's very similar to what's happening in the universe, right? So catalysts, right? What does Newton's first law says? A stock which is in motion will remain in motion. A stock which is at rest will remain at rest until an external force comes. So inertia, the idea of inertia, right? So unless there is a new catalyst which enters the picture, the stocks will not make any big move. They'll just be stay in that range. The second law obviously is about momentum itself, right? Newton's second law is about momentum. And the third law is about action and reaction, right? Which is what mean reversion is all about. That if, for every action, you have to have a equal and opposite reaction. So it's just beautiful how, the laws of the nature coincide with what happens in the market. So now with all these, structural principles we've studied, so what is the conclusion, right? So like I said earlier, they are just tendencies, right? They are just tendencies. They are not formulas. So do not think, but knowing them can make you a much powerful, much more better trader, right? Knowing these structural principles and operating, with those principles, behind your back, and thinking about these principles when you're operating in market can really take your trading and investing to the next level. And that is what the topic of this whole presentation is, right? So think about these principles, and not only think about them now, but think about them while you operate in the market, right? And if you find something that is not working, or that you feel is wrong, please come back to me, because I'm more than happy to learn. But this is what it is. But the real power of these tendencies, right, they come when you combine multiple structural tendencies, right? So if you combine momentum and volatility contraction, that is when you get, what the most powerful breakout traders do. They're doing nothing but combining volatility and momentum, volatility contraction and momentum. Similarly, if you combine catalysts and mean reversion, right? What it means is a stock that is beaten down and a new catalyst comes into the play, you will get an explosive move. So you're applying a catalyst on a normal stock versus applying a catalyst on a stock with mean reversion are a completely, what Charlie Munger calls the Lollapalooza effect, right? So people who have read Charlie Munger, when you combine two strong principles, so 1 + 1 is not 2, right? So 1 + 1 is 122. So it's just that much more powerful. Similarly, if you combine catalysts and size and neglect, right? So you've got a catalyst in a small company which was neglected, you will get an even bigger explosive move. And I can give you several examples of these. I don't have time for that right now. Okay, so let me just see if I can, right? So the example of this I'll give you, catalyst and mean reversion, is one of the stocks that I just showed you apart, right? It made an explosive move. Okay, let me do this. Yeah, so this was the day, which is an example of catalyst and mean reversion, right? See, this is the day earnings was declared. So there was a catalyst, and this was a stock which had corrected almost 25% from the highs. So when a catalyst met a stock which was mean reverting, right, you got an explosive move. You got an explosive move. Forget about this move later, but look at this move itself. The move from 31st Jan to 16th Feb, right? In about 10 trading days, you got a move that was 70%. If this news had come without this phase of the stock falling, let's say the stock was roaming around here and the news had come, the stock would not have made such an explosive reaction. The explosive reaction happened because the catalyst met with the principle of mean reversion, right? Similarly, the other example I showed you is Electra. It made an even bigger move, right? 1, 2, 3, 4, 5, maybe about 10 days, it moved up 93%. How did it move 93% in 10 days? Here is a stock which was not only neglected, right? It was falling. It was just falling, right? After this big move, which ended in December 21, nobody wanted this stock. And here we are in February 23, right? Almost 1.5 years later. Stock has also corrected. So mean reversion is there, neglect is there. Electra is a small company with low float. So you have the size, you have the float, and then you get a catalyst on this day, and just see what happens after that. Stock makes a move of 90%. So this is the power of combining catalysts and, building, so every situation you have to analyze it as a combination of these catalysts. All right, so next we will move into how to combine exactly what we have been talking about, how to combine these and build them into setups. Now, the idea of setups is something that is very, very important, right? So what we have spoken so far are just principles. They are just, big ideas that, okay, this is what might happen. This is what, can happen in most scenarios. If I combine these two, then this can happen, and so on and so forth, right? So let's move to the idea of setups, which will make these structural principles into strategies. How do you convert structural principles into strategies? Okay. So before we get into the idea of setups, right, I want to address one more thing. A lot of people in the market, I see on Twitter also, they say that there is only one way to invest, right? Some of them will say traders are idiots. Some of them will say investors are crazy because they take so much drawdowns. I am smart because I am not taking a drawdown. Some investors act holier than thou. They say that I am an investor, so I am great. Traders are, lowly creatures. So, it's something that you see on Twitter every day, but it's a very, very, very limiting way to understand markets. You have to open yourself up. You have to open yourself to the ideas, be curious, and try to figure out how does the market actually work, right? And that is what we did using the structural principles. Now, what I want to say is that please remember, there are not 100, actually there are more than 100 ways to make money from the market. Okay. So just because somebody is telling you that only you have to follow the Warren Buffett way or you have to follow the particular trader's way, that is not the truth. There are many, many ways to make money in the market. What matters is that you pick up one or two of these paths that resonate with your personality and become true to it. That is what matters. Otherwise, what happens for most investors is they keep hearing about these strategies from multiple people. Somebody will come and say, that follow this strategy, you will make money. Somebody will say, follow that. So you will come and you will try this, you will, somebody, okay. So I think some people, just can't, anyway, so you'll keep jumping from strategy to strategy. And that is what keeps a lot of retail investors, not get into profits, because you feel that the way to approach market is that there is some formula which will, make money for me, which will work. And, just if I just follow that, then, okay, what do I need to do? Disable annotation. Okay, let me try that. All right, I think it's done. Okay, and how do I remove this now? What is already there on the screen? A lot of you are Zoom experts here. Yeah, that's good. Okay. All right, I think we're good. Yeah. So, this idea of setups, right? So there are multiple ways to make money from the market, and you don't have to depend on somebody else's strategy, right? That will never make you money. So you have to use the structural tendencies to build a setup that works for you as a person, right? So you will have your own personality, you will have your own restrictions, you will have things that will resonate for you. So you have to back it up and build a strategy for yourself. That is the only way to trading success or investing success, right? And every big investor, they will all be using the same principles that we discussed, some time back, but they would have made something out of that is unique to them. And that is what is the idea of a setup, right? You have to build your own setup. So what is a setup? A setup is essentially a repeatable pattern, which has an edge, right? So how to get an edge is very clear. Just combine one or more structural tendencies or structural principles into your pattern, and then look for a repeatable pattern, in stock. So we'll discuss this. Let's say, right? So what do I mean by repeatable pattern, right? So you have to be very, very clear. What is it that I'm looking for, right? What are the conditions that I'm looking for? Is it something on the chart? Is it something on the earnings? Is it something on the macro? So you have to be very clear. What are you looking for, right? That is very important. Then you have to know when do you have to act. Then you have to know how much you have to bet on each of these acts, and then you have to know when do you have to get out. So a setup is nothing but a clarity of thought on all of these four things: what to buy, when to buy, how much to buy, and when to sell. You have to have this almost coded into your mind that this is exactly what I will do. And if you can do that, then you can really solve 80 to 90% of your problems. If you are acting in the market without having a setup, you are lost and you're making suboptimal decisions, dumb decisions, because you don't know you just don't know what you're doing, right? So if somebody is trading, let's say the earnings strategy, right? So you have to very clearly know, okay, what am I looking for? What am I looking for in the quarterly earnings? What type of a growth? What is going to happen in the margins? What is going to happen in the bottom line? Okay. Once I see this, how do I decide when to buy? Do I buy it on the day of the earnings? Do I buy on the gap up at the open? Do I buy it, on the second day, the third day? When do I buy it? And how much do I bet on each of my, bets? And finally, when do I exit, right? So that clarity has to be absolutely there. And this, all professionals, right? If you look at, let's say, Mark Minervini is a very famous guy, right? What is his setup? His setup is nothing but a combination of momentum and volatility contraction, right? Anybody who follows Mark Minervini will know that it's a combination of momentum, right? He calls it, I think, the momentum part of it is called as a trend template. So he has defined a trend template which identifies momentum, and then he calls it as VCP, right? Like somebody put it in the chat, it's volatility contraction pattern. So it's a combination of momentum and volatility contraction, which he has made as his setup. Now, is that all there is to a setup? No. Like if you attend Mark Minervini's masterclass, right, or if you attend or you read his books, he will tell you about this. But the difference is between him and you is that he has a crystal clarity of what exactly a VCP is, what should I look for in VCP, how many days of contraction do I look for? Like he marks them as T1, T2, T3, and all of that. That is not how I will use VCP, or that is not, you might have your own version of VCP, right? So a setup of Mark Minervini's, when you take up, it is about making that setup your own, right? Not just take because it's Mark Minervini is telling you to follow this setup, you will never be successful. You have to take that setup, go deep, understand what exactly is happening here, and have answer to all of these questions. You have to write it down in a notebook or in a notepad. What exactly am I looking for? When do I push the trigger? When do I buy? How much do I buy? And what is my signal to sell? Right. So if you look at Warren Buffett, let's leave aside the traders, right? What is Warren Buffett doing? What tendencies is he using? Warren Buffett is using a tendency of neglect to buy quality companies. He wants to buy quality companies when they are neglected, right? So any of your favorite traders, go back and think about it, which structural tendencies are they using, right? So 3 ingredients basically in setup, right? So like I said, one is the edge, but the most important ingredient is time frame. So if you are beginning to build a setup of your own, the first question that you have to answer is, what time frame am I playing? What time frame am I playing? That is the first question you have to answer. Without this answer, you will be lost in the market. So there are people who want to play the intraday time frame. There are people who want to play multi-year time frame. There are people who want to play multi-decadal time frames. And your time frame will decide what setup you use, right? So like I said, if you are somebody who is working, right, you're a working person, you cannot do intraday trading, as simple as that, right? You have to understand that, right? If you are a working person and you want to do intraday trading, it is just not possible for you to sustain it or excel in it. You might still be able to make money here and there, but we are not talking about that, right? We are talking about excelling. We are talking about really making the big money, or making performing very well. So if you are somebody who's a working person, you cannot do intraday trading, right? So you have to get rid of all the setups which are intraday. Just get rid of them, right? So if if you're somebody who is involved with the market, who can take one decision, you can look at markets once a day. Then you can look at something like a swing or a position trading, right? If you're somebody who doesn't even want to look at markets on a daily basis, then you can look at mutual funds. So that gives, this time frame decision gives you clarity, right? If you're somebody who loves fundamentals, who loves analysis, who loves understanding businesses, then your setup will be completely different. So all of us can have setups which suit our time frame, which suit our personality, and create them. So just because you have one setup and somebody else has some other setup, it doesn't mean that that guy is inferior or you are superior. It just means that for your personality, for your routine, for your the way you are set up, what you like, you have to pick a setup that suits all of that. So if you tell a fundamental investor to start trading based on charts, they will hate it. And if you tell somebody who's using charts to look at fundamentals and study balance sheets and listen to con calls, they will hate it. So your setup, so you have to be very clear. Okay, do I want a pattern based setup or do I want a fundamental based setup? There are some of us who might say I want a combination of both, which is also possible, right? So it's finally about building setups is all about finding a pattern and finding a time frame that works for you as an individual, right? So once you define a setup, you have to be very clear, how do I execute the setup, right? So what tools do I need, how do I set myself up? So every setup will have a different set of needs. So like I said, if you are a intraday trader, then you will have a different set of tools that you will use. You will have a different set of books that you will read. You will have a different set of people that you will follow. Your time you get up in the morning will be different, right? Everything will be different. So if your setup is that of a fundamental investor or a swing trader, all of these things will again change. The tools will change, the people you follow will change, what you read will change. So you have to finally come to, and you have to take that plunge. Do not keep jumping from one strategy to another strategy. Think about this very hard. Think about your time frame decision. Think about what time frame you want to play, and then go back and try to look for patterns which fit that time frame, and then find something that again fits your personality. Only if you do this will you be able to put in the time and effort to make excellence happen. Otherwise you'll just be just another trader who just comes in the market, and basically best case you'll make no profit no loss, or you'll make some profit, you'll be happy. But if you're serious about this business, then you have to inculcate setup based thinking. Without setup based thinking, you cannot succeed. Every big investor, go back and look at them critically, you will find that they all have setups. Warren Buffett has a setup. Why did Warren Buffett not participate in the 2000 tech boom? Because he had that clarity of thought that my setup is to bet on companies which do not change. The underlying fundamentals don't change very fast. He had that clarity, which is why he is so successful, right? Mark Minervini, right? People made fun of him because he did not know fundamental of some company, right? That UPST or something, or some of you might know about that. That is not important. What is important is that he is crystal clear about the setup that he trades. And that is why he's a millionaire. And the rest of the people on Twitter are just laughing at him, right? So it's very important that you start setup-based thinking. You have to find one pattern, start with one pattern and master it. And then you can go to other patterns. Look for one pattern, one strategy that works for you, and master it. Give it time, learn about it, and you will make money. Like I said, making money in the market is no big deal at all. You will make good money if you stop jumping around here and there looking for some formula and focus on building your own setup. Somebody's asking, can you pursue value and technology? You can do anything you want. See, that's the whole point, right? You can do anything that you want, but the setups have to have an edge. The edge will come from structural principles that we spoke about. Once the edge is there in the setup, what is an edge? An edge is something that that there's a higher probability of this working. So once an edge is there, you start building the setup, start identifying patterns, study the patterns, and I will talk about that a bit later. But how you can develop mastery of a setup, study the patterns and make that setup your own, make it work for you, right? Essentially make a setup work for you, but have that clarity that I am only going to focus on this set of rules, this set of patterns, whether it is fundamental, technical, or a mix of both, just doesn't matter. So this is a good time to talk about two setups, right? So I've just picked up randomly two setups, breakouts and catalysts, right? So like I said, there can be two types of setups, right? So one are pure pattern-based setups, whereby you're purely trading off the charts. And then there are setups which can be fundamentals based, or which can be news based, or which can be a combination of charts as well as fundamentals and business and all of that, right? So these are the two setups. Now let's look at breakouts, right? So in breakouts, essentially what is every breakout trader doing? What is every breakout trader doing is he is basically using two structural tendencies. Number one is momentum, and number two, like I said, is volatility contraction or catalyst or mean reversion. Every breakout trader essentially is using the fundamental attribute of momentum. And then he can combine that idea of momentum with any of the other structural tendencies. So there are breakout traders who will break out when there is news and a breakout that happens together. There are traders who don't care about the news or information. They will break out, they will trade a breakout whenever there is a momentum and there is a volatility contraction, right? There are people who do pullback trading. There are traders who will keep the stocks which have already broken out on their radar and they buy them on a mean reversion or a pullback. So these are just examples of how many different setups and strategies you can make by using a combination of the structural tendencies. So all of these will have an edge because they are based on a structural pattern. Again, time frame, right? So breakout traders can be intraday. They can be trading intraday breakout. So they can be trading, multi-day, multi-week, multi-month breakout. Or there are people who will trade multi-year breakouts, right? So time frame again is a choice that you have to make. And depending on what you have chosen, you have to set the appropriate process. So when I say process, what it means is what type of scans you are running. So when it comes to pattern-based trading, essentially how pattern-based traders work is they try to work on the basis of scans. So they will either run scans, which will tell them that these are your potential candidates, or they will do manual screening of all the 100, 200, 500,000 stocks, and they will create a watch list out of that and then operate from there. So you can, if you feel that your personality is that of a pattern-based trading, then breakouts is a very good setup for you, right? So within breakouts, again, like I said, you can define, okay, do I want to trade multi-day breakout or do I want to trade multi-week breakouts? So what type of a breakout do I want to trade, right? And purely pattern-based. So you don't like to do fundamentals and all of that. There's no problem. There are many traders who make a very good returns and living purely out of pattern-based trading. So you have to look at that. Now, if you're somebody who loves businesses, who loves analyzing news, who loves analyzing earnings, then you can look at catalysts as a setup. Like I said, the catalyst as a setup can be mixed and matched with other ideas like size and neglect and momentum and all of that. So what is time frame concept in a catalyst, right? So any catalyst need not give you only big moves. Catalysts can also be used by people who are trading for 1 or 2 days kind of a move, right? So if you look at any of the stocks, like tomorrow or day after when the market opens, just go back and check which stocks have made a big move. Just randomly go and check for today which stocks have made a big move, and you will find that almost all of them will have some or the other news. If a stock has made a move which is significantly large for its, compared to its normal move, then there will be a catalyst. So even as an intraday trader, you can focus on stocks which have news, right? You can, because typically the stocks which have these news will open gap up or gap down. And once they open gap up or gap down, you can define a particular pattern, right? So you might wait for some consolidation and then you buy a breakout from there or something like that. So, or you can trade catalysts, for a multi-week, multi-month kind of a thing. Like I said, or, in earnings, like how we do it, right? In earnings, what we do is we are looking at multiple quarters. So we are looking at, a time frame of multiple quarters. So my process to identify earnings catalysts will be very different from a person who is trading a day catalyst, right? So these are the two, setups to give you some quick examples of, let us say, breakout and how people generally do this kind of breakout trading. Let me just go to a few charts. Again, this Delta Corp I kept as an example, to show you the catalyst, so the news flow, how the news flow leads to big moves, right? Why did this fall happen? This fall just didn't happen out of the blue. This fall happened because some catalyst entered the picture, right? So, but anyway, so let us look at some stocks. You have any examples of breakout? Let me see. Let's look at some of the railway stocks. Oh yeah, I think BSE is a very good example. BSE is a very, 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 very good example of a combination of a breakout and a catalyst. Okay. So BSE, again, same story, neglected stock, right? Neglected. And this move, right? This move, if you're a momentum trader, then you cannot participate in this move because you have to wait for the momentum to set up. Okay. So once the momentum set up, okay, let's say this move happened, right? From 29th March, right, to here, you can see that this stock is in momentum. This stock is in absolute momentum. Now this stock has a catalyst, right? So what is the catalyst? What is the catalyst for BSE? Anybody in the chat? What is the catalyst for BSE? Yes. No, it's not management change. It's not buyback. Yes, the catalyst is not NSE IPO. Yes, the catalyst is options. The catalyst is the derivatives, the options. The introduction of options and the fact that BSE was able to, on expiry day, get a market share of as much as 30% of what NSE was doing, for that Sensex expiry on Friday. That was the catalyst for BSE. And that is what led to this big price move, right? So this is a great example to teach you multiple things, right? So like I said, neglect, mean reversion led to an explosive first leg, right? And then you have this volatility contraction here. And then you had this breakout with volume. See, huge volume happened here. And this huge volume, right, from 605, the stock went all the way up to 1,400, almost 140% move, right? And then what is this? This is nothing but a pullback. This is nothing but a mean reversion. The stock that has gone up non-stop has to pull back. This is mean reversion in play. And this is so depending on your interests, right? Depending on your interests, you can become a pullback trader, you can become a breakout trader, you can become, exhaustion also, like somebody correctly, pointed out, right? So non-stop going up. And this is the day which gives you exhaustion, but again, not so much because the volume is not there. But yeah, maybe a mild exhaustion here, right? And again, the concept of, age is important here, right? Now, this move has been happening from April 23, and we are now in September 23. So now this move is not very young, but still it's not very old yet, right? So it's not very, somebody's saying stage analysis, right? So stage analysis is something which is completely different, right? Stage analysis, maybe stage analysis can be thought of as a setup, which is a combination of, the first stage is the neglect stage, right? The second stage is the stage 2 is what is the momentum stage. The third stage can be called as a mean reversion or an exhaustion stage, right? And the fourth stage can be thought of as a downward momentum stage with a momentum on the other side. So like I said, you can explain any setup, anything in the market using these principles. So everything comes back to these core principles, right? All right. So let me go back. Yeah, so I spoke about breakouts. We spoke about the idea of catalysts. I spoke about the idea of combining catalysts with breakouts to build your setups. Let's come to the final few thoughts here. So sizing and portfolio construction is again very important. A lot of people randomly, I also did a video on this, on the idea of portfolio allocation. right? So again, do not go with the, like, don't accept anything at face value in market. I think that's rule number one, right? So you have to think for yourself. Somebody is telling you become a concentrated investor. Somebody is telling you become a diversified investor. No, that is not how it works, right? You have to figure out what is right for what you are doing. The most important learning from this presentation today should be that you have to figure out a way for markets to work for you, right? You cannot keep you cannot keep listening to 10 different people, get 10 different ideas. That is not how learning happens, right? So sizing and portfolio construction is purely a function of what you are doing in the market. What is your setup? What is your time frame? What is your risk reward? These three questions will define what should be your portfolio construction looking like. What should be your sizing looking like, right? So if you, let's say, if you are somebody who is investing in cyclicals or investing in something which is based on fundamentals, right? You like a business, you like the business model, and you basically you're investing for multiple years. So you're taking a position for multiple years. Now, making a very, very big bet on such a position which you're going to hold for multiple years is absolutely, so the risk management there from the point of view of the context is completely wrong, right? Because over that next 2 to 3 years, when you hold that position, you will very easily see drawdowns of 50, 60, 70%. Will you be able to hold through those drawdowns? What if a black swan event happens over the next 2 to 3 years for your stock? So a big position is bad, not for everybody. A big position is bad for the person who is taking a 2, 3, 4, 5 year bet and who just wants to sit on that, and even then it's not bad. It's about whether you can manage your temperament and psychology, right? But generally speaking, a big position is not bad in itself. A big position for a setup that has a large drawdown is risky. Why do you think the venture capitalists invest in hundreds and thousands of companies? Because they know that their setup is, some of the companies will give me 1,000, 5,000, 10,000% returns, but most of my companies will lose 90% or 100% of the money. That is their setup, right? So basis that setup, they create their portfolio construction. They say that if I get even one winner, I can make up for 100 losers. That is why they become very diversified. They say that for our setup, I have to be very diversified. Show me one venture capitalist who is a concentrated investor. You can't, because it doesn't make sense. That is how institutions think about sizing and portfolio construction. They think about it in context of their setup and strategies. You do not start with, I am a concentrated investor, so I will buy only 5 stocks. Or I am a diversified investor, so I will buy 100 stocks. You do not start with portfolio construction. Portfolio construction is an offshoot of your strategy and your strategy's risk reward equation. Now, let us say you're an intraday trader, a manual intraday trader. Okay. If you're a manual intraday trader, obviously the risk that you are taking is very low, not from the point of view of leverage. I'm talking from the point of view of how wrong can things go over a span of next 2-3 hours, right? So if you've got a good pattern, if you've got a good setup, you are very sure that I'm not holding this overnight. So unless some sudden intraday news comes, which also you will be prepared because you know what are the events. Is a result going to be announced today, or is something else going to happen, or some other announcement is going to come? So as an intraday trader, you can afford to take very big positions because you know that your risk is contained. You are not holding it overnight. That is why intraday traders take very big positions. So you have to have this clear understanding of when you can take big positions and when you can't, right? So if just because you see an intraday trader who takes a big position and he tells you that the secret of my success is my position sizing, because I put 100% of my portfolio in one idea, and you go and do that for some other strategy, then you will be out of the market. So remember this principle that portfolio construction is an offshoot of your own risk reward equation and your own setup. Portfolio construction is mainly about structuring it in such a way, your portfolio, so that you can follow the rules that you have set at the beginning, and you will not abandon your setup or strategy due to psychological pressures, right? So when I trade my, the earning strategy or anything like that, I stay reasonably diversified. Why do I stay reasonably diversified? Because two reasons, right? Because one, I know that if a company has had a good earnings, and probability of it doing well over the next 1 quarter is very high. Let us say it, even if it doesn't work, some other stock in my portfolio will work, because I am just playing the probability. I do not know which of the, 3, 4, 5 stocks out of the 20, 25, 30 stocks I own will be the best performers over the next 1 quarter. I really don't know that. I am only betting on the fact that this company is showing a good earnings trend, and because of my analysis, I think this earnings trend can sustain. That is my strength. That is what I have built up over the years, and I go and buy a bunch of those positions. Can I decide that I will buy only 5 stocks which will be the best performing stocks from an earnings point of view over the next quarter? No, I can't do that, because that's just not how I am set up, right? So I will buy a bunch of them, and more often than not, I've said this before, the stocks which perform the best in your portfolio will be a surprise to yourself, right? Because it's just not predictable, because the performance of the stock is a function of many variables. It is not just a function of the earnings that it announced, right? It's a function of many other things also, right? So it has to be your portfolio construction has to be thought about from the point of view of your strategy or your setup. Right. So we discussed this. Right. 1 second. Yeah. Okay. This is a big one. Okay. This is like the really big one as far as retail investors are concerned, or any investor, right? Why should I single out retail investors? I'm saying retail investors more from the context of new investors, people who have just come to the market. The idea of market environment is a phenomenally important idea, right? So that's what I've written, right? You can't make it rain without clouds. You need a good setup, but you also need a good market environment to succeed, right? In a bad market environment, very few people can make money. So when I say bad market environment, I don't mean that a bull market is good and a bear market is bad. Again, market environment is in the context of the setup. So if you are a value investors, you will thrive in a bearish environment. You will thrive in an environment of panic. Right? What do you think Howard Marks does? Howard Marks is an investor who thrives during panic, because he is ready with cash to pounce on such opportunities, right? So he has a setup, right? He has very clear patterns as to what type of company will I buy. He is very clear, but he is acting in the right market environment for him. That is what has made him the big success. Similarly, Warren Buffett, sitting on stockpiles of cash. They are all investors who thrive in a bearish market environment. But let us say your setup is momentum. If your setup is momentum, or you're a breakout trader, and you trade in a choppy or a bearish market, you will be killed. You will be killed by the market. No matter how good your setup, no matter how good your structural tendency, nothing will matter. Because if you are, like I said, right, if there are no clouds, it cannot rain. If the environment is not right, a setup will not work. The hit rate will just go for a toss. So it is very important to figure out as a next step, once you have your setup, when does this setup work? In what market environment does this setup work? Right? It's paramount that you do that. Now, as portfolio managers, right? A lot of time investors expect that in all environment we should be able to perform, but it just is not possible, right? If you're having an environment where, let us say, the broader markets or the Nifty is down 15-20%, it is next to impossible for somebody who is exposed to the market at all times, like a mutual fund or a PMS, to perform, right? So market environment is very critical, and market environment as a function of your setup is even more critical. So how do you evaluate the market environment, right? So like I said, it has to be based on your setup. Different setups will thrive in different market environments, and it's very important that you understand in which market environment your setup will work, right? A good example of this I'll give you, like a lot of these momentum small cases were doing very well in the market in the period of 2021, and then they utterly failed in the period of 2022. What is the reason? The answer is right in front of you: market environment. If you are running a market, if you're running a momentum strategy in a market which is in a corrective phase, you are setting yourself up for failure. So you have to know which market environment will my strategy thrive in, and operate aggressively in that market environment only. This one concept can be a big game changer for a lot of you. So typically, what tools are used for analyzing the market environment from the point of view of the bullish and bearish market environment point of view? Typically, the two main tools used are breadth and moving averages. So I already spoke about breadth. It is basically trying to figure out how many stocks are above 200 MA or 50 MA or any such indicators, right? How many stocks are hitting 52-week highs? How many stocks are hitting 52-week lows? How many stocks are positive over the last 1 month? How many are positive over the last 3 months? So if you look at this data for many months, many years, you will start seeing patterns. And these data can tell you the nature of the market environment. So if the breadth is very low, then it tells you that we're in a bearish phase. If let's say the breadth is more than 60%, 70%, then you know that you're in a bullish phase. If the breadth is crossing 80, 85%, then you know that you're in a super bullish phase, right? Similarly, moving averages are used, right? So all the top indices, right? All the top indices, Nifty, Bank Nifty, small cap, mid cap, how are they placed with respect to their moving averages is used to gauge the market environment. Now, let's say Nifty and Bank Nifty right now are very weak, but the mid cap and small cap indices are very strong. And that is exactly what is happening in the market. So if you are a breakout trader, or if you are an investor, then you have to focus, or if you're a growth investor, right? So you have to focus on the mid and small cap segment, because that is where the market environment is bullish. And the market environments in Nifty and Bank Nifty and the constituents is kind of choppy, if not bearish, right? So these are the tools typically used to gauge the market environment. Yeah. So putting it all together, right? How do you convert? Right? A lot of gyan I have given all of you this afternoon, right? So how do you convert all this gyan into money, right? That is what matters. Because end of the day, whether it's about money or not, money is how in the stock markets we keep score, right? So it's about it tells us clearly in no hidden terms, how we are doing as investors, how we are doing as traders. So how do you put this to practice, right? So like I said, number one, now that I have exposed you to the idea of structural principles, keep looking for them everywhere across the markets. Keep looking for them in stocks. Keep looking for them in sectors, and study and try to apply these concepts as they happen in the real market. Try to apply structural principles, or think about structural principles on your existing strategies, right? Figure out which structural principles is your existing strategy using. Is it using any structural principle at all, or are you just shooting in the dark? So that is what you should do as the first step. And the next, right, like I said, the secret is not in the setup, right? So you will find many setups on the internet. You will find, like I said, just in breakout, you will find 10 different Twitter handles who are telling you how to trade breakouts, right? The secret, even if you go and ask them personally, they will tell you that the secret is not in the setup, right? The secret is not in the setup. It is in making it work for you, right? It is in spending time with those patterns, building the clarity of thought, and refining and understanding the nuances. So what are the nuances? The nuances are things which we just discussed, right? Things like okay, given my setup, what is the optimal way to construct the portfolio? What is the optimal way to size my positions? How do I know in which market environment I have to use this, setup? In which market environment I should, tone down my exposure? So the magic is always in the nuances. The only way for you to learn any of the strategies that anybody is teaching you is to get your hands dirty and spend time in building clarity of thought and understanding the nuances. There are no direct formulas in the market which will always work, right? So you have to be devoted to it to make it work. So one of the ways, right? I'll before I stop, I'll tell you one of the ways in which you can do this, and the way in which professionals do this, right? So some professionals call it a deep dive, some professionals call it historical precedent analysis, right? Mark Minervini, I think, calls it historical precedent analysis. Some people call it a deep dive, right? Some people call it case studies, right? So anything that you are trying to excel in, you have to go back and study those patterns in the past. You have to study how did these breakouts work how did I learn my earning strategy? Tell me. The way I learned the earning strategy is by sitting down and analyzing earnings and price action post the earnings for multiple years, right? It is not something that I just stumbled upon, because the idea of earning surprise is not my own idea, right? It is an idea which there is a research paper on it called peak earnings announcement drift, right? PEAD. It's a very, very famous thing which was done, I think 20, 30, 40 years back by some Australian professor, right? So it is not a new idea, but I made that idea my own by working on it, by studying it and figuring out, okay, if earnings come like this, then what happens? If earnings come like that, then what happens? If earnings come in a bear market environment, what happens? If good earnings come in a bull market environment, what happens? If good earnings come in a low float stock, what happens? If good earnings come in a large cap stock, what happens? So how do you learn this? You have to learn this there is a lot of data out there. You have to learn how did your strategy or setup work in the past, and you will have all the answers there. You will not need me or anybody on Twitter. So once you have figured out that, okay, this is my time frame, I am going to trade or I'm going to invest with a time frame, let us say, of 1 year. I want to trade, on an yearly time frame, or I want to invest on a yearly time frame. And this is the setup I'm going to use. And this is the so once you know that this is the setup, this is the time frame, then you have to go back and study that setup, right? That how did this setup behave? Don't have to go really back, just go back 5 years. Don't have to go back 20, 30 years, just go back 5 years. If you don't have time, go back just 1 year. 1 year, and find out how did this situation work in the past. 1 year I am not recommending, because in 1 year you will not get all types of market. To really learn this, you have to see how it worked in a bull market, in a bear market, in a choppy market, in a range bound market. So you have to figure out all of those use cases. So you have to really go back and check this. So somebody's asking about the paper, right? It's called Peak Earnings Announcement Drift. I think somebody put it up. Just search on Google. But that paper will not tell you anything, right? That's the point I'm making. The paper will just tell you that, fine, stocks which give you good earnings tend to keep moving up. Like, it is just a principle of catalyst, which we spoke about. That is what the paper says. Similarly, momentum is a very well-known principle. So how you make it work for you, right? That is the point, right? Yeah, sorry, it's not. Did I say peak? Okay, it's post earnings announcement drift. So post earnings announcement drift means once the earnings are announced, after that, how does the stock move, right? So that is what it is. So yeah, so I think that's about it. 3:35, 1.5 hours, 1 hour 35 minutes. I'm happy to help. Mail me directly, or I have a blog. You can also send me something on Twitter. I'll be happy to answer. I'll be happy to engage. As much as time permits me, because the idea of doing this whole thing, is to, like I said, help people who are in my position. When I had to learn, on my own, and like I said, many people helped me. If people, were not open with their knowledge, then I also would not have learned, right? That is what I am grateful for. Several people, like I said, both in India and abroad, have shared that knowledge generously, right? So that is what it is all about, right? So if I can shave off at least a few years of your learning, or save you from a few mistakes, then I think the job will be done. Yeah, any questions? I think I can take them now. You can just type them in the chat. Just keep them coming a bit slow so that. Yeah, I'll try to share the presentation with all of you. I'll take one liberty actually. I will. So see, I write a blog, so I will add whoever has subscribed to this, workshop into that blog list, because otherwise that whole mailing thing, right? So many emails did not go out and all of that. So I think with the blog thing, what happens is the Substack takes care of all of that. So I'll add all of you to my blog, and if some of you are not interested, you can unsubscribe. So I will not feel bad or anything. So you can, you can do that. So because then I'll share the presentation on the blog so that all of you can access, and even people who could not make it to this session can, hopefully access. So any questions? I think there are too many comments coming in right now. Let me see if I can. Let me just scroll through a few questions. Okay, how to differentiate between a strong and a weak catalyst, right? R. Kul is asking, how do I differentiate between strong and weak catalyst? See, it is something. See, again, there is no. I cannot give you, a set of steps, right? It comes from experience. So one option, like I said, is for you to do a historic precedent analysis on this, right? So look at stocks which have made strong moves. Like I gave you the example of Electra, and go back and study around the time when that move started. What was the news that came in the exchanges, or just do a search on Google News or search on Twitter, and try to build these kind of case studies for yourself, right? So if you go and check, that is one way to do. And weak catalyst, right? Weak catalyst is something which will not make a big difference on the underlying earnings perception of the stock, right? So to give you an example, so I'm not sure if it's a weak or a strong catalyst, but the entry of Hero Honda into that Harley Davidson, right? That was a catalyst which worked for a few days. Eicher was falling and Hero Honda was going up. But then I think market realized that, both of them can coexist. So a catalyst like this, right, which are very kind of, which give you a hazy picture about the whole thing, right, are generally weak catalysts. Strong catalysts are very clearly, you can feel it in your bones, right, that they are game changing. So let me show you an example of, the same company, Apar. It has been one of the stocks also as a disclosure, which I have owned. Let me go to, okay, how do I go? Let's go to our favorite site, Screener, right? Go to Apar. Is it visible? My screen is visible, I hope. Yeah, okay. So let's look at the numbers here, right? So just look at the change, right? So the company which was around 1,800 to 2,000 crores suddenly makes a move to 3,000 top line, and from doing 100, 130, it makes a operating profit of 174, and immediately it does a operating profit of 237, right? So whenever you see like this kind of 100% growth in operating profits or bottom line, or more than 50% growth in the top line, you clearly know that it's a strong catalyst. right? You clearly know that's a strong catalyst. Similarly, any management change, right? A very bad, like CG Power is a very famous example now, right, of management change when Murugappa Group took over. When Murugappa Group took over, right, everybody knew the news, right? Even, let's say, where is it? I think it was somewhere after COVID, I think, post-COVID happened. Yeah, I think somewhere here, right? So I think somewhere around here that news came of Murugappa Group taking over, and the stock kept making non-stop upper circuits, right? So a strong catalyst will be very apparent to you, which will be very clear. It's not that complicated. The problem comes between an average catalyst and a weak catalyst, right? So, and you have to also see the management change in the context of, see, CG Power was in bankruptcy. Now, if this management change happened in some other company which was doing normal operations, nothing much would have happened. But CG Power was in bankruptcy and it was taken over by a gold standard management like Murugappa's. That is what did the magic. If a management change happens in CG Power at this price, then nothing much will happen. So that is where it's important to analyze the catalyst in the current context and understand whether it is strong or weak. Okay, so what else? For an investor playing mean reversion, how should he ensure he is not too early? Yeah, one of the ways you can do that is, Anant is asking, right? If you're playing mean reversion, how can you ensure that you're not early? So one of the ways is to allow the idea of momentum to be clubbed with mean reversion, right? So whenever you are having a mean reversion, let's take this example of CG Power itself, right? Okay, let's go back to CG Power. Right, so CG Power was essentially an idea, it was a mean reversion, right? A stock got beaten down. There was a catalyst, right? So you are not sure what will happen, right? When CG Power news came, let's assume that you were able to, it was not upper circuits and there was some volume and all of that, right? So you need not participate here, right? So you can participate here also. So you allow the first leg to happen. In the next consolidation, you can buy it. Or the next breakout from the next consolidation, you can buy it. That is how. But again, if you're taking that risk, then you're leaving money on the table. And why are you leaving that money on the table? Because you do not have the expertise to judge how strong the catalyst is. So the stock was in mean reversion. A catalyst came into the picture, but you did not know anything about Murugappa. Let's say you are a new guy into the market. You don't know who Murugappa is. So that is the price you are paying for not knowing, because then the market has gone up and then you see that, okay, the stock is going up, seems to be a good management. You've done all your research by then. You can also participate here, right? You could have bought it at around 30, 35 and nobody would have complained, right? So yeah, that's how you can do it. Do you feel that retail investor has to have multiple perspectives rather than being wedded only to one perspective? No, of course, you have to have multiple perspectives, but you should have one setup. That is what I'm trying to say. When you are in the market to make money, you have to be very, very clear that I have, like when you go to work, right? You have one job, right? Let's say you are a software engineer, right? So if you are somebody new, you will be working on one project at a time, right? And you are supposed to put all your mental faculties to make that work, right? So it is like that. So when you're new to the market, make one setup work for you first. Perspectives and all is okay, but make one setup work for you, understand that setup, build expertise in that setup, and that is how you can make money. How to identify and execute your ideas, especially from problem of plenty. How do you make trade between value investing and breakout? If it is value, may not have a breakout. If already breakout, price may not be cheap. Okay. How do you, problem of plenty? Yes, there is a problem of plenty. That's what I said. That is a problem with retail investors. People get confused because there are so many ways to make money. Should I be a technical trader? Should I be a fundamental investor? Should I follow Mark Minervini? Should I follow George Soros? Should I follow Warren Buffett? I think you have to pick one. Okay, pick one which really resonates with you as a person, right? If you feel that trading is not for you, take the ideas of Peter Lynch, take the ideas of Warren Buffett, but take them seriously, right? Take the ideas seriously. So if you're a Warren Buffett type of an investor, you have to be clear that I will invest very rarely. I will probably take 1 or 2 decisions in a year. I will invest only in established companies. I will invest in established companies only during periods of neglect. So that clarity you should develop. And if you are saying Warren Buffett and then you're doing completely different something, then there is no point. So problem of plenty is there, but it's actually that's a problem of plenty. You have to come out of that and pick one setup which resonates with you, right? Could you please spend some time on quantitative approach to position sizing? Quantitative approach to position sizing, yes, see, it is like I said, a quantitative trading strategy has to decide the position size, right? So like I said, it is a function of the strategy. It is not whether it is quantitative or qualitative. It is a function of what strategy you are running. So if you are an algorithmic trader who is doing market making, right, you will have very, very diversified portfolio. You will operate in multiple scripts, right? If you look at market makers in the US and even market makers in India, they will be they are there in the trade for a few seconds or a few minutes or a few microseconds. So they are quantitative in nature, right? So but they are quantitative, and if you have built some strategy on Amy Broker, you are quantitative, are two different things. So quantitative is not important. What is important is what is your strategy, time frame, and what is the risk reward of your investments and trades. Basis those numbers, you have to decide your position sizing. Okay, what else? How to identify momentum at indices level using moving average and market breadth indicators. See, identifying momentum at, let me show you. Let's say Nifty, right? So typically momentum in an index, typically what these professionals do is they say that if the price is above the 10 and the 10 is above the 20, then the index can be said to be in momentum, right? Look at this phase here, clearly a momentum phase. This is a phase. This red line is the 10, the white line is the 20. So this is the phase where the index is in a momentum. And when the price is below the 10 and 20 and both of them are trending down, it's called a bearish phase. It's very simplistic, but it gives you a broad idea, right? So, and it's always true. If you want to identify a momentum phase in an index, just look at the price in relation to the 10 and 20 and look at how the 10 and 20 are in terms of their direction. So are they uptrending or are they flattening out? That will give you a fair idea of where the index is. What are the quantitative filters you use to call it a set of earnings? Will it fit as a catalyst? The quantitative filters I use are, typically, like I said, right, I want to see top line growth. I want to see operating profit growth. I want to see margin expansion happening from a period of low margin. So these are the few things I look at. Okay, I think I'll take a few more questions. Analysis that can be used in bear market. Can you list some strategies that can be used in bear market apart from value investing? Strategies to be used in bear market, so like I said, there are these people, a lot of traders who use, who play mean reversion on the other side, right? So bear markets are very famous for what is called as bear market rallies, right? In bear market, there are very, very strong up moves that happen, right? You can look at that in, I think, the NASDAQ right now, right? So look at this phase. So this was a downtrend, right? Now in this downtrend, you will get these periods where stocks will rally for a few days or a few weeks. Like you had one rally here, you had one strong rally here, you have one strong rally here, you had one strong rally here. The market as a whole has been going down. but you had 1, 2, 3, 4, 4 or 5 such opportunities in bear markets to play, momentum on the upside, right? So that's one of the strategies that many people use, right? Use the bear market rallies as a short-term trading strategy. Other than that, yes, you always have value investing because bear markets are where value investors thrive, right? That is the market environment they look forward to, because that is where they get the valuations cheap. That is where they are able to, get the stocks and sectors that they want. What are the recent catalysts you are focusing on? No, I am open to all catalysts, right? So we have a mechanism to track earnings, to track news, corporate announcements. We track everything, right? So we are paranoid about it. We track everything. We might not be able to trade everything or invest in everything, but that is how you build expertise, right? Whether you buy or not is not important, but you have to study the catalysts, right? You have to see when a catalyst comes, what happens to the stock. So that is how you learn. So next time when some situation like that happens, you are in a position of strength and you know what is likely to happen. So catalysts typically will be, like I said, news or earnings. Right? These are the two main catalysts. Within news, you will get 10 different types of news announcements. So that is something you will have to explore. Suzlon management change, yes. Suzlon management change, yes. But how much do we know about the new management, right? So is it like a CG Power Murugappa situation? No, right? So and Suzlon is a stock which again is a neglected stock. Please bear in mind that the reason why stocks like Suzlon give you such strong rallies is because they are neglected, right? Now that the stock has already gone up, one has to be careful. But stocks like Suzlon and all of these are hated by the market, and because they are hated by the market, they provide opportunities for short-term traders. So these are not stocks which are meant for investors. But for short-term traders, the principle of neglect comes into play here, and they can give very sharp rallies. But Suzlon management change, I'm not sure. I've not studied it deeply, but I don't think it is some gold standard management which has come. Suzlon, the story is more about what's happening in the sector itself. The catalyst is not the management. If the catalyst was only management, then only Suzlon stock would have gone up. But all wind energy stocks are going up. So that tells you that the catalyst is something else. The catalyst is more to do with what's happening, in the energy sector, in the power sector, and the kind of investments happening. So that is the how to deal with good earnings but bad technicals. No, that's what. So it's not about dealing with it. You have to be clear, right? So sometimes if the earnings are good, I will go out and buy the stock. I will not wait for the price because I am confident that my earnings analysis is fairly good. So sometimes what happens is, even though a company comes out with good earnings, the stock will not make a move at all. So a new investor will be confused, what to do. So the price of waiting for the market to tell you that yes, this earnings is good, is that you have to buy 20-30% higher. So how to deal with it depends on your expertise in analyzing the earning. So if you can tell before the market that I know that this earnings is good, and right now just because the broader market environment is not good, the stock is not going up, so I will go ahead and buy it. So it is that which matters. Okay, I'll take a last few questions. Yes, do you use market tendency to sell a stock? All the time, all the time. Like I said, I very much use the ideas of euphoria and exhaustion, and mean reversion. I use them very, very strongly, both while analyzing the fundamentals and the price action to decide if I should take some profit off the table. So market tendencies are very, very important to tell you not only when to buy, but also when to sell. All right. Forced selling by institutions on demerger listing is a tendency. Forced selling by institutions. Yeah, I think special situations is a setup. Okay, special situations is a setup. And like you rightly said, yes, I think Mukku Jodha has said this question. Yeah, the tendency there is of exhaustion, right? The tendency there is of A special situation is a setup which is based on the idea that the institutions will sell a stock because it's too small for them, which will lead to an exhaustion in the price, and there will be a mean reverting bounce back, right? So a special situation is a combination of multiple things, right? It's a combination of exhaustion, it's a combination of a mean reversion expected, and it is a combination of a catalyst also in many cases. Without having a catalyst, you will see that a special situation will not work. For a special situation to work, you need a catalyst. And typically the catalyst will be, suddenly the company will start reporting good numbers because of the demerge that has happened. The balance sheet would have been cleaned up, or any of the legacy capital allocation decisions will not have a bearing on this company. So maybe the interest costs go down, or some other things will happen, which will give you a catalyst for the price to re-rate. The catalyst, combined with the fact that the stock is neglected or is in an exhaustion phase, will give you a supernormal return, which is what typically happens in good special situations. Okay, what are the few indicators to identify top and trigger for selling? Like I said, peak earnings, QIP. Yeah, these are all, again, catalysts or news or events. You have to see peak earnings you can track by a single metric, that is margins. If you see that the margins have expanded for the last 3, 4, 5, 6 quarters, then you know that, like I said, right, mean reversion is around the corner. So margins are a very, very good way to, predict the peak in earnings. Can we say mean reversion is preceded by exhaustion? Mean reversion is preceded by exhaustion. Should we say exhaustion is preceded by mean reversion? So what I want to say is that first the exhaustion will happen, and then the mean reversion will happen, right? So like I showed you in IRCTC example, the stock goes up non-stop, for multiple days, and then it gets exhausted, and then a mean reversion back happens where it falls 30, 40, 50% over the next, several days and months. All right, I think we should stop it. It's about 4 o'clock, like 2 hours, like we planned. I don't want to keep you all on a Sunday evening. Just a request. If you have any questions, please reach out to me on Twitter. And also post your feedback on Twitter, and hopefully